Welcome back to the Deep Dive. Our mission today is to give you a genuine shortcut to becoming really well-informed on the absolute foundation of any investment strategy.
We really dug in this time.
We did. We took a deep dive into sources defining the two critical pillars you have to establish before you put a single dollar into the market. That's your time horizon and your risk tolerance. And our sources, they included major financial research, foundational texts on wealth management, and they all focus heavily on this relationship between time and volatility.
It's the core tension, really.
It is. And to set the stage, let's just start with a quote from Howard Marks that, honestly, it summarizes the whole idea. He said, "Volatility is the price you pay for access to long-term growth."
That statement is, well, it's the core truth of investing, and it tells you why so many people struggle with it.
How so?
They want the growth, but they're not willing to, or maybe just not able to pay the price. And that price is the temporary, sometimes really violent fluctuation in value.
Right.
An investment plan only becomes actionable when you define not just what you're saving for, but when you need the money, and exactly how much fluctuation you can actually handle without panicking.
And as always, a quick but important caveat from the material we look at.
The disclaimer.
Disclaimer. This is all educational and informational only. This is not personalized investment advice. You have to do your own homework. And look, if you need a tailored plan, go speak to a certified professional advisor.
Okay, let's get into it.
Let's do it. Let's unpack this by starting with the time horizon. So we're talking about the duration your money can realistically stay invested before you need to cash it out for a specific goal.
Right.
The sources define three simple categories, but the insight here isn't. It's not the definition itself. It's the immediate implication for risk.
Exactly. The time you have, that is what gives you permission to take on risk. Let's look at the three risk time categories the sources lay out.
Okay.
First up, you've got a short-term horizon. So
Yep.
less than 1 year. In that case, your risk tolerance should be basically zero. Your absolute priority is safety and liquidity. You just cannot risk losing money you know you're going to need in a few months.
But the crucial line the sources draw is that transition point. Once you move into the medium term, which is what, 1 to 5 years?
1 to 5 years, yeah.
Your capacity for risk starts to go up. You can integrate a moderate level of risk, gives you a chance to beat inflation, but you still need most of that capital protected.
Of course, because 5 years is not enough time to guarantee a recovery from a major crisis.
Right.
And then we get to the long term, and this is defined pretty decisively as 5 years and more. This is the crucial category.
Why is that?
Because 5 years is historically a baseline where you gain the capacity to absorb most market fluctuations. For really ambitious goals, the sources actually suggest aiming for 10 years or more.
10 plus.
Yeah, because that duration lets you maximize your potential growth by taking on the maximum acceptable volatility.
Okay, let's ground this in reality using the examples our sources provided.
Good idea.
So if you're saving for a trip next year, a classic short-term goal, you're prioritizing a regulated savings account or maybe a money market fund. Low risk, high liquidity. Makes total sense.
Now, for the medium term, let's take that example of a house down payment in, say, 4 years. You want some growth, but you absolutely cannot risk losing 20% of it right before you need it.
Of course not.
So the strategy shifts. It becomes about moderate risk. The sources suggest a mix, something like maybe 80% in what they call principal protected assets. So funds designed to guarantee your initial capital.
Okay, so your base is safe.
Exactly. And then the other 20% in growth-oriented components, which might be broad stock index funds, ETFs, something like that. It's a carefully measured push for a slightly higher yield.
And for the long-term goal retirement, 20 years from now, the whole objective just flips on its head.
Complete.
This is your high volatility zone. You'd choose a highly diversified portfolio of stocks and broad index funds, ETFs, because you have time on your side. The risk of those short-term dips is, it's neutralized by the long-term upward trajectory of the market. That's it. The time horizon dictates the risk, period.
And that's the main principle we really want you to take away from this part. Time is the great risk reducer. The moment you define your time frame as 10 years or more, you gain the statistical permission to accept significantly more risk at the start.
Because time will compensate for those inevitable drops we're about to talk about.
Precisely.
That sets the perfect tension for our second factor, risk tolerance. We can define our time horizon objectively, it's a number. But risk tolerance is entirely subjective.
Oh, completely.
It's your psychological capacity to watch your portfolio drop, sometimes severely, without succumbing to panic and making the absolute worst decision.
Which is selling at the bottom.
Selling at the bottom.
For long-term growth investing, especially in, say, broad market index funds, you have to mentally commit to two core and honestly challenging assumptions.
What are they?
First, that the market is fundamentally bullish over the long term, 5, 10, 20 years. And second, you must believe that the market will eventually recover after a fall. You don't know when, but you know it will happen.
Believing those things in theory, though, that's the easy part. Living through the reality of a market drop is a whole other thing. So how frequent is this price of volatility we have to pay?
It's constant. It really is. The sources warn that frequent, smaller drops, what we call corrections, where the market falls between 10 and 20%. Those happen approximately every 2 years. That's just the ambient background noise of investing.
Wow. So if you plan to invest for 20 years, you need to be prepared for like 10 of those 10 to 20% drops. That's a lot of emotional friction.
It is, but then there are the big ones. Absolutely. The rare catastrophic crises are unpredictable, but they are inevitable over a multi-decade investing life. These are the drops that cause major declines, 40, 50, 60% market crashes.
And the discipline required there must be immense, because the emotional pressure to cut your losses when you see your life savings cut in half, that's got to be overwhelming.
It is.
So let's tackle that emotional friction head on. Our sources offer a really crucial reframing mechanism for these big drops.
This is a huge mindset shift.
It is. Instead of seeing them as a disaster signaling it's time to sell, these should be viewed as buying opportunities. They use the phrase a fire sale, like everything is suddenly priced lower.
It requires you to act completely counterintuitively. When everyone else is panicking and selling, you need the discipline to keep buying, or at the very least, just stay put.
And this is why risk tolerance is so personal.
It is. It's not just about what you can afford to lose on paper. It's about what level of that temporary paper loss you can psychologically endure without just abandoning your entire long-term plan.
And beyond that personal psychological battle, you have all these external risks, right?
Yeah.
Things that influence asset values. For instance, central banks raising interest rates dramatically.
Like we've seen recently.
Exactly. That can instantly reduce the value of fixed income assets like bonds. Or a major geopolitical crisis can spike energy prices, hitting industrial sectors all over the world. These things happen whether you're emotionally ready or not.
Which brings us to risk personalization, or what's often called risk appetite. And this varies massively from person to person.
Also,
Some people, they thrive on higher risk for the potential of higher returns. They see volatility as excitement. Others, they just want to prioritize capital preservation and, sleeping well at night, even if it means lower yields.
and the sources really emphasize that the specific high-growth plan we're focusing on, the one built on broad ETFs and long horizons, it only works if your personal risk appetite aligns with high volatility.
That's the key.
If you're the kind of person who's going to check your account daily during a downturn and feel intense stress, you have to adjust your risk exposure downward. It doesn't matter what your time horizon is.
It's just an honest assessment of who you are. Time only protects you if you have the mental fortitude not to sell when that protection is needed most.
That brings us to the statistical proof. The data validation that confirms this patience is actually worthwhile.
The hard numbers.
The hard numbers. The sources introduce a powerful study that turns this whole philosophical discussion into statistical reality. It was called History Backs Market Recovery, conducted by State Street Global Advisors in 2025.
This is a crucial piece of research. It looks not just at the fact that markets recover, but at the speed and the predictability of that recovery.
So what was the methodology?
They looked at nearly a century of data, analyzing 25 major S&P 500 corrections, so any drop greater than 10%, all the way back to the 1920s.
Wow, 100 years.
Pretty much. And they tracked the systematic returns after 3, 6, 12, and 24 months following those drops.
And the results, when you compile them over a century, are they're astonishingly consistent. And they should be the cornerstone of every long-term investor's belief system.
Right.
What stands out is that returns after a correction are systematically positive. It proves the market almost always bounces back, and quickly.
The short-term bounce is impressive enough. You're looking at average returns of plus 2.8% after just 3 months.
3 months.
And plus 5.4% after 6 months. That shows you immediate market stabilization.
But here is the ultimate aha moment. that validates the whole long-term approach. The data confirms the average return after a correction jumps to an impressive dip, plus 14% after 2 years.
14%.
That is a huge return for simply having the discipline to stay invested through the dip.
This data strongly validates the principle of reversion, this idea that markets always tend to snap back and return to their original trajectory. They effectively erase the loss over a relatively short period.
And this held true even after massive shocks, right? Like the 2008 financial crisis or the COVID crash.
Even then, yes.
So if you're looking for evidence that patience and discipline are not just, abstract virtues, this is it. The data statistically proves that corrections are temporary phases. They're not a signal of long-term decline.
Precisely. It reinforces the absolute necessity of staying invested in broad, diversified funds like ETFs. When you look at those numbers, a 14% average bounce back in 2 years, it changes the whole calculus from fear to opportunity.
It's an invitation to discipline.
An invitation to discipline founded on a century of historical evidence.
That brings us to our final consolidation. If there's one simple mantra to take away from this entire deep dive, it is this: adapt your investment plan to your unique profile and your specific project timeline.
Let's summarize the 5 non-negotiable points we covered, the principles you really have to internalize.
Let's hear them.
First, define your investment horizon clearly.
Okay.
Short, medium, or long term. Second, the longer your horizon, especially 10 years or more, the more risk you have to be willing to accept early on to maximize your potential returns.
Good.
Third, you must consciously accept volatility. View it as the non-negotiable price for aiming for true growth. Fourth, crises and crashes are unpredictable, but the data proves they are systematically full of opportunity.
Provided you have the cash and the discipline to enter that fire sale.
Exactly. And fifth, always ensure the level of risk you take is personally adapted to your psychological limits and the constraints of each specific project.
And a final essential reminder drawn directly from the source material: investment decisions demand self-consciousness and dedicated research. At the end of the day, you, the investor, remain solely responsible for your choices and the outcomes.
This knowledge is power, but it requires thoughtful action.
We'll leave you with a final thought on how to use all this information, and it comes from Charlie Munger. He said, take ideas wherever they are, but use your own brain to assemble them.
So, a question to consider then. Knowing that historically, the market provides an average 14% bounce back rate within 2 years of a major correction, how might that knowledge change the physical and emotional way you view and react to the next major market dip?
That's a powerful question to mull over. Thank you for joining us on this deep dive into time, risk, and growth.
Thanks for listening.
If this knowledge shortcut was helpful, please do us a huge favor. Add a like to this deep dive and subscribe to the channel for more focused conversations delivered right to you.